Thanks everyone for joining us today on another My Wealth webinar. Today should be pretty exciting. We have Andrew McCreath. Andrew runs and is the CEO and CIO of the Forge First Asset Management Group. They run a number of alternative strategies, and they have been brilliant in terms of reducing volatility and capturing upside. He is also found often on BNN and is a common commentator there as well. So it's a pretty good time, especially rolling into the new year. Also on the line, we have Dave Townshend and Rahim Somani, our senior investment advisors on the team. And if you have any questions, feel free to reach out to one of us. We do have a Q&A button at the bottom. So if you have any questions for Andrew, more than happy to ask on your behalf. And with that, let's get started. Andrew, just you want to give us a little bit more brief background on yourself and your strategies that you run?
Sure, sounds good, Jeffrey, and good afternoon, ladies and gentlemen. Thanks for joining Rahim, Dave, Jeffrey, and myself on the call today. Absolutely, please do not be shy about asking questions about anything that's on your mind. I am going to share a few pictures with you and some thoughts on markets looking into 2024. On my website, which is forgefirst.com, you will find my monthly commentary, which was posted last Friday morning. And near the end of that commentary, you'll see about 12 bullets that highlight a few of our quote-unquote predictions for 2024, which we'll delve a lot deeper into in the year ahead commentary that will be released during the first full business week of 2024. Got to get used to saying 2024. I always remember years ago when 2001: A Space Odyssey was way into the future. That was a long time ago. Anyway, sure, I'll just give you a little brief introduction about myself and Forge First Asset Management. After 10 years in the rock and roll business, I went to university, completed an undergraduate degree in finance, a master's degree in economics, and now I've been in the investment business for a long time. I was a sell-side analyst for 8-9 years, had a firm called Gordon Capital, and now I've been managing money for 30 years. Forge First was started just under 12 years ago by myself and my co-founding partner, Fatima Harani. Fatima is our COO and CFO. As you said, Jeffrey, I'm the Chief Investment Officer, CEO of the business, and I'm the UDP from a regulatory perspective, the ultimate designated person. I'm pleased to say to you that I moved to Calgary 20 months ago. I'm loving it out here. It's just such a marvelous place to live relative to Toronto, where I had lived the rest of my life. But I'll leave it at that, and I'm just loving it out here. The outdoor life is awesome. People are friendly. It's a very chilled environment. And some of you may laugh when I say this, but there's no traffic here. It's great. Anyway, Forge First is fortunate enough to manage about $950 million of client capital between our two investment strategies. We manage a long-short fund, and we manage what we refer to as a conservative alternative fund. The long-short fund is targeting growth-oriented investors. It's all stocks and liquid options, as opposed to the conservative alternative fund, which is targeting capital preservation-focused investors. In addition to being, holding common stocks, it will also own public credit and always have a sizable exposure to index puts and index put spreads. Our goal at the firm is to generate a competitive net return and protect capital when markets get rougher. Philosophically, we're the tortoise that beats the hare is what we're all about. We're not about beta. We're not about chasing momentum. We're about being steady Eddie. We have a 12-person team. That includes a 6-person investment team, 1 trader, 3 analysts, and 2 portfolio managers. And then in addition to those 6 people, I'm the Chief Investment Officer. That's a little bit about the business, shall we say. Our funds have been operating for about 11 and a half years, and they both have a solid track record at generating competitive returns and definitely protecting capital when markets get rougher. Now, when we look ahead into 2024, clearly the outlook is a little different than it appeared to be 12 months ago when it comes to the stock market. But when it comes to interest rates, it's kind of funny because it's kind of the same. If you think back 12 months ago, financial markets were pricing in 3 rate cuts by the Fed during the back half of 2023. The market was trading at 18 times forward earnings at that point in time. Now, inflation, it was still definitely sticky. And at that point in time, 12 months ago, as you could read in my monthly commentary from back then, we went into 2023 with low net exposure because we did not believe the Fed was going to be cutting interest rates in the back half of 23, because inflation, we believe, was going to prove to be higher for longer, shall we say. Consequently, at 18 times forward earnings for the S&P 500, we didn't find the markets particularly attractive. Well, were we right? Were we wrong? Doesn't even matter at this point in time. But when one asks that question of were you right or wrong, you probably know that aside from the 7 or 10 tech stocks, the market didn't do much during the first 5.5 months of the year. Then there was a bit of a bid for a couple of months in the broader stock market, which then went away for 2.5 months. And then, of course, it roared back during the month of November. And consequently, when you look at market averages, obviously the headline S&P is up a heck of a lot, but the vast majority of it is those 7 or 10 stocks, and the rest of the market is up a few percentage points. Definitely, it's mattered where you had your capital. I mean, obviously, bank stocks have been disappointing. Energy stocks, they've had their good and their bad times. Obviously, gas is under tremendous pressure right now. We'll chat about that in a few minutes. And when it comes to bonds, I don't think bonds are a buy here. But before we get into the specifics, let's step back and look at a couple of pictures that matter. And so I am going to share my screen. Here we go. So I'm hoping that you can see this picture right here that says Fed balance sheet, the red line on the left vertical axis, against the macro liquidity index, which is the white line. And if you look,
Andrew, it's just not coming up on the screen at the moment. Yeah, it looks like it's coming on now. Yeah,
good. Okay, so if you look at the bottom left-hand corner, you can see this graph starts in 2018, and I did this graph up this morning, so it's current as of, I guess, last Friday's close. The red line on the left vertical axis is the size of the balance sheet of the Federal Reserve Bank of the United States. The white line is how we calculate the liquidity index for the United States. In other words, how much liquidity is in the system. Now, the red line is probably intuitive what it is. It's the balance sheet of the Fed. The white line includes the size of the Fed's balance sheet, plus changes in reverse repos, plus changes in the size of Yellen's checking account, the Treasury General Account, or the TGA. So it's a proxy for the amount of liquidity in the system. Now, you can see when COVID happened, right? Because both the red line and white line went vertical early in 2020. The reason I'm showing you this graph is, in the fall of 2021, it's my opinion that central bankers told you they're going to change the rules of the game. They said they're going to hike interest rates and they're going to shrink their balance sheet. Now, the Bank of Canada did that. The Bank of Canada hiked interest rates a lot and did it quickly. And they've also shrunk their balance sheet by more than 50%, 50. Whereas you can see from this graph here, the Fed, it shrunk its balance sheet, but nowhere near as much as the Bank of Canada has. The Fed shrunk its balance sheet by about 15%, 1.5. And in addition to that, because of reverse repos and the way Yellen has run down the checking account, recently replenished to a degree by the issuance of treasury bills, the amount of liquidity in the system in the States, the white line, remains gigantic relative to where it was before COVID. So what's happened here? Well, the Fed did one thing, hiked rates, but they didn't really do a lot to change the amount of liquidity in the system. And I think that that is one reason the stock market had actually been okay this year, even if the equal weighted index didn't do a heck of a lot during much of 2023. The outlook for liquidity is going to be important. I would suggest to you that liquidity is going to tighten a little bit next year. Anyway, I just wanted to share that picture with you, and now I am. Give me a second here. Stop the share. There we go. I'm just going to stop that share, and I'm going to move on here. There. Great. Okay. So I think that's been a key driver for markets this year, the amount of liquidity that's in the system in the United States. What about the economy? Well, I thought we were going to have something close to a recession this year. Obviously, I was wrong. Why? I was wrong for a couple of reasons. One, because I underestimated the amount of cash that consumers had on their balance sheets as a result of the stimulus provided by President Biden. And interestingly enough, the Bureau of Economic Analysis in the United States, the BEA, 3 times this year has gone back and upwardly revised the amount of cash that the consumer had on their balance sheet, the amount of excess cash. And that obviously gave the consumer a lot more legs than I would have thought would have been the case a year ago. Item number 2, Biden's stimulus programs, whether it's the CHIPS Act to promote the building of semiconductor plants, whether it's the misnomered word IRA, the Inflation Reduction Act, and there's a couple of other programs. And these have had the effect of providing gargantuan industrial policy-oriented fiscal stimulus in the United States that have materially impacted growth this year and are going to continue to have legs into 2026. Now, in contrast up here, there's really been no industrial policy programs at all from, frankly, any level of government, but especially the federal government. The money that was put on the table from Ottawa post-COVID was really about paying for groceries and paying for rent. There was no industrial policy involved. And the absolute numbers, well, we may be of the view that they were ridiculously large. They were peanuts in the grand scheme of things relative to what they did in the States, which of course they can do because they have a reserve currency status, meaning that foreigners have to spend money using the US dollar or they buy bonds, whereas Canada does not have the luxury of being reserve currency, having reserve currency status, and consequently they've got to be a little more careful at how they spend dollars and the amount of money they spend. Again, you can debate what I just said, but bottom line is the stimulus in the States was way larger. So be it cash on the consumer's balance sheet or be it Biden's stimulus programs, that's the reason that the U.S. Economy stayed afloat this year. Now, there's a lot of talk about what about next year? Well, one of our predictions for next year is, the U.S. is not going to have a recession. And it's frankly for the same 2 reasons. That excess cash is expected to extend to the end of spring of 2024. And wage growth continues to hover at levels that are comfortably above their historic averages, meaning that with a reduction of inflation, which I think most of us assumed was going to be a predictable road down to, call it 3%. We didn't know the timing, but it has happened. The road from 3 to 2, I think, is a bunch tougher. But with wage growth still at 4, maybe even 5%, certainly here in Canada, since the rate of unionization is 5 times greater in Canada than it is in the States. The consumer has got legs a little longer in the States. Here in Canada, the debt to income ratio is punitive, up at, call it 175%, whereas in states in the private sector, it's half that. So again, it's another check mark for the US consumer. The last check mark for the US consumer relates to mortgages. They take 30-year mortgages in the States versus the 5-year ones we take up here. And so while the mortgage rates in the States are, call it, 7 to 7.5, down from 8, the average mortgage rate in the US today is 3.7% because 30-year durations. Whereas here in Canada, we all know that we've got a brewing problem here that will become a big problem if interest rates aren't a lot lower a year from now, because it's entering 2025 where the mortgages become very problematic for real estate in Canada and consequently the banks, or should I say the taxpayers. Sorry, a little tongue-in-cheek comment there. But the U.S. consumer is fine, and then Biden's stimulus programs keeps going. So we think the combination of those two items will enable the U.S. to skirt a recession again. Here in Canada, maybe not so lucky. I mean, there's little question we benefit from the strength of the U.S. economy to arguably little reason done by ourselves. But if the U.S. doesn't have a recession, we're likely to be in better shape than we might otherwise be. But we still could move into a recession here in Canada. So to that end, I will table another prediction for 2024, and that is our currency. I believe that there is the potential for more stimulus out of China, especially on the monetary policy side of things, and for the European Central Bank to ease before the Fed, and of course, the Bank of Canada to ease before the Fed. Therefore, I think the US dollar stays stronger for longer, at least in the front half of the year. And I think the Canadian currency, given another prediction that oil, we're not going to $100, we're not going to $110. I think it's going to be range bound. I said in my commentary last Friday, 75 to 90. Well, this morning, we wish oil was $75, but I'm going to say 75 to 90 for next year. But without that really strong oil price, and with the Bank of Canada likely cutting before the Fed because of the debt to income ratio in the private sector and the potential problems for mortgages as we get later in 24, approaching 25, I think the Canadian dollar goes to 70 cents. And I think there's a decent shot we get the proverbial 6 handle on the Canadian dollar during 2024. So the economy, I think growth remains okay in the States, and I think it'll be more problematic in Canada. So to that end, again, I'd like to share a graph here with you. And let me just see here, share screen. So I've taken all these graphs are from Bloomberg. I love graphs, and I keep lots and lots of graphs in Bloomberg. You can see in the bottom left-hand corner, this graph starts in August 2022. And what this graph is showing you is at the point in time displayed on the horizontal axis, the forecast for 2023 or 2024 GDP in the United States, the white and red lines respectively, was what was shown on this graph here. So you can see that from the beginning of 23, the white line has been consistently grinding higher. And then over the last few months, let's say from the midsummer 23, the forecast for 24 has been getting better, such that if you squint your eyes on the right-hand side, you can see that the Bloomberg consensus forecast for economic growth in the States next year is about 1.25%. Which, isn't exactly rocking, but it could be a heck of a lot worse. So I think that speaks to my outlook for growth. I am now going to, let's see here. There we are, stop share. Let's chat about Another reason that the economy is not going to get a heck of a lot worse in the States, that has to do with the labor market. So I'm going to share my screen here. Bear with me. What you're looking at here are initial jobless claims. Now, I'm sure that you, like me, have read these comments about how initial jobless claims are increasing. Well, you can see in the far left-hand side of the horizontal axis here, this graph starts in the late 1960s. The shaded vertical.
It's just it didn't populate this time.
Oh,
sorry. Perfect.
Garbage in, garbage out, Jeffrey. I'll take the blame for that. So just to refresh, look at the bottom left-hand corner. You can see this graph starts in the late 1960s, so call it a 60-year graph. The shaded orange bars are recessions, and the white line are initial jobless claims. Now, you can see how the jobless claims historically has cranked a lot higher going into those shaded orange bars, recessions. Look at the far right-hand side. Yeah, initial claims have gone up, but they're barely off the bottom. Incredible when you think of it. I'm going to bear with me here. And I would say that you may express a little surprise at the inconsistency between investment people, economists, what you read in the press about recession, no recession. And a key reason why I think there's been a higher than usual degree of confusion about, hey, what's the economic outlook going to be? It has to do with the mixed picture we get today. If we go back and look at previous cycles and assume this cycle is going to be like previous cycles. Let's look at this graph here. So what are you looking at? Well, again, you can see on the far left-hand side of the horizontal axis, this graph starts in the late 60s. Those shaded orange bars, they mark recessions. The yellow bars are the LEI index, leading economic indicators. Let's just look at the yellow bars and the shaded orange vertical bars by themselves right now. You notice what happens. Start from left and go to the right. You notice how the yellow line goes below zero as we approach those shaded orange bars. In other words, the leading economic index is predicting a recession. And sure enough, those yellow bars go deeply negative in those recessionary periods. And then, of course, they come out the other side as the recession ends. Now let's add those two other lines in our analysis. Look at the white line. That's continuing claims. Now, the previous graph I showed you was just the new initial claims in a given week, unemployment claims. Whereas this white line are the number of claims that are continuing, okay? In other words, it's not new ones. They're just continuing to be on unemployment, let's call it. So look at that white line. You can see historically it goes up into those shaded orange bars. Look at the far right-hand side. Again, it's barely off the bottom. Look at the red line. Now, you can see that the red line only starts 20-odd years ago. That's the JOLTS, the job openings. And again, you can see the red line goes down into those shaded orange bars, and then it goes up. Look at the top right-hand corner of this graph. Yeah, the red line's gone down a whole bunch, but it's still way above where it has historically been. So this sends you a confusing picture, because on the far right-hand side of this graph, you can see that the LEI index is deeply negative, implying a recession. But look at the white line and look at the red line. And this inconsistency with past cycles is the case for a whole bunch of variables. And that is one of the reasons that I think a lot of folks, and I'll include myself in there, has not been correct with respect to predicting a recession or predicting that we will not have a recession. My only saving grace is I don't pretend to be an economist. I'm a money manager. Anyway, all jokes aside, let's look at this graph here. Again, starts in the late 60s. You know by now what those shaded orange bars are. You can see the red line is the unemployment index in the States inverted against small businesses hiring plans in white on the right vertical axis. There's a good correlation between the two, and you can see they've decoupled. So in the top right-hand corner, the falling red line, of course, is an increasing unemployment rate because it's inverted. Whereas the white line, you can see small business is considering increasing its employment headcount relative to a couple of months ago. So bottom line is, it's tough to have a recession if the labor markets are going to continue to be as strong as they are. So that's my comment on the economy. Let me express an opinion on inflation. I'm of the view that, as I said earlier, that a year ago, the road to 3% was easy, but going down to 2% was going to be tough. I still think that's the case. I think goods inflation is relatively dormant. It's just that good pricing stays at really high prices. It's ridiculous how expensive everything is. Service pricing, of course, correlates to wage growth. And wage growth, as I mentioned, has been softening, but it's still high relative to historical levels. And I think when you look at the number of job openings, when you look at the rate of unemployment, that it's going to stay pretty sticky at higher levels. So I think service inflation does stay a little stickier for longer. Now, what does that mean for interest rates? Well, if you listen to Chairman Powell, during 2022, he made a lot of comments that he does not want to make the same mistake that Fed Chair Arthur Burns made in the 1970s. That mistake was having Burns cut interest rates before inflation had been pounded into the ground. And so 2 years later, inflation came roaring back. And so with the economy in decent shape, and with the labor markets being in decent shape, once again, I think we're exiting a year with the market being overly optimistic on the timing of Fed rate cuts. Why does Powell need to cut interest rates? He doesn't need to. The economy's fine. The job market's fine. Now, as of late last week, financial markets were pricing in a 60% chance, 6-0, of a rate cut in March, and 100% chance of a rate cut by May of 24. They're starting to price that out a little bit after the jobs report last week. I think you're going to see more of that priced out. Now, equities have backed off a little bit from the euphoria of November over the last couple of days as those rate cuts start to get priced out, but they've hardly, stocks have hardly gone down. So I think that the first half of next year is going to be kind of choppy because I don't see those rate cuts coming until the back half of the year. Whereas I think we get them out of China, Europe, and probably the Bank of Canada during the second quarter of next year, i.e. before the Fed. And so I think stocks will be a little choppy as they digest that reality of the Fed not cutting. Now, this Wednesday afternoon, we've got another press conference by the Fed. It's they basically told you they're not hiking interest rates, nor should they. The question is, how hard does Powell push back at the market pricing in rate cuts? I think he will push back because I don't think they'll cut until the back half of next year. So let's shift to oil for a second, and then we'll get into markets. So I wish to show you this graph here. Okay, share my screen. Okay, what do you see here? You'll see this graph starts in 2014 on the far left-hand side. And you see that the red line are the number of wells that have been drilled. The yellow line is total oil production in the United States. And the white line are DUCs, drilled but uncompleted wells. So notice the decline in DUCs from mid-20. So again, this is only a 10-year graph or a 9 to 10-year graph, but you can see on the far right-hand side that the white line is by a country mile the lowest it's been during that last 9 to 10 years. So you've had a lot of companies drill a lot of DUCs, but from the red line, you can actually see there's a gentle downward slope during 2023 of wells that have been drilled. So effectively, the cow is being milked. Now, that bodes well for oil in the future, with the exception of the fact of all that shadow inventory that there is, especially in Saudi Arabia. Because as you know, they have taken more than 100% of the quota cuts on behalf of OPEC+. Meanwhile, the yellow line on here, as you can see, is at a new high, U.S. oil production. And it hasn't been those public companies, has it? It's been private equity that have been drilling those wells, or I should say, completing the DUCs as opposed to drilling the wells. So when one looks at oil, separate from gas, which I'll comment on in a moment, our outlook for 24 is that oil is going to be stuck between 75 and 90 bucks through WTI. What do we own? Well, we've been big fans of Athabasca. Simple fact of the matter is, if you get $77 oil, if you get a 70-cent Canadian dollar, Athabasca, call it 15 cents higher from here, was trading at an 18% free cash flow yield on 24 and 25% free cash flow yield on 25. We think oil will, as I said, be range bound. It's likely to have a better front half of the year than gas. And then I think gas gets a little better in the back half of the year. Now, that was our view as of 2.5 weeks ago when I was in Toronto and we had a 3-hour investment team meeting identifying, our opinion on the outlook for a whole bunch of variables. The ones that I mentioned are in my commentary that was posted last Friday morning. You can find on our website, foragefirst.com. At that time, natural gas was trading higher, a lot higher than it's currently trading at this morning. Fact of the matter is, we thought that NYMEX gas may get a one handle on it over the next few months. We certainly are moving very quickly to seeing that. At that time, I would become more interested in gas because as you move towards the back half of 24, two things happen. In the United States, you start to see new LNG export capacity come on stream to suck up the gas that's being produced in the States, as, for example, Permian wells get more gassy. At the same point in time, not going to try and pinpoint the date, but LNG Canada will start up. And given how the vast majority of Shell's return on investment from LNG Canada correlates to phase 2, not phase 1, I think once they get phase 1 commercial, they will announce phase 2. And that'll be good for Canadian gas stocks, or it should be good for Canadian gas stocks, because any participants in LNG Canada, if you own 20% of the LNG Canada, you've got to supply 20% of the gas. And while the shareholders have enough gas to meet their own commitments for phase 1, they do not for phase 2. Shell, for example, being one of those companies that does not have enough gas for phase 2, which, let's face it, is not coming on stream in the next 2 years. But I suspect that you'll see a firming of AECO prices when LNG Canada comes on, and there's probably a degree of being game on. So let's go back to energy. To summarize, we thought gas was going to be very weak in the front half of 24. We're seeing a lot of it now. Probably there's still more to come. Oil, we thought was going to be better than gas in the front half of the year, and then maybe not as good as gas in the back half of next year, but still just range bound. The problem with energy stocks is I don't think there's any new buyers. Whether it's ESG, which, yes, I realize has largely been discredited by the investment world. Bottom line is it still does work because pension funds and sovereign wealth funds have been told to watch what they invest in. So the price of a stock is a function of supply and demand. And I think the demand is structurally challenged for energy stocks. And so while we had that, marvelous rip in the front half of 22, ever since then, the stocks they've had their good times and bad times. They've been choppy. I think they're going to continue to be choppy. We've long owned Tourmaline and C&Q. We believe they're the best companies in the space. And obviously, they pay out a lot of their cash in dividends. And when one looks at our investment philosophy, it's always to have a very liquid book. In other words, and that's because having a liquid book means you've got a repeatable process. So we've always invested in North America versus just Canada, and focused on larger cap stocks than smaller cap stocks, so that we can increase the probability that we have a repeatable process. That's my 2 cents worth on energy. When it comes to stocks themselves, I want to show you one graph here. Where is it? Here it is here. So, get up a little bit more there. So what you're looking at here on the far left-hand side, it starts in 1980. And the red line are small cap stocks divided into large cap stocks. So in other words, relative strength. And the white line are those same leading economic indicators that were yellow on previous graphs. I should have made them yellow on this one, but bottom line is I didn't. And then, of course, what those shaded orange bars are. So look at what happens. As the LEI goes negative just ahead and into a recession, the red line, the relative strength of small cap into large cap stocks, goes down. In other words, small cap stocks underperform. And as you veer from left to right, it's pretty predictable. Now let's go to the far right-hand side. What's happening right now? Well, you can see that there's no signs of a bottom in the relative strength of small cap to large cap. And, of course, this is suggesting we should be in a recession, but we're not. But when one looks at the outlook for 2024, I believe the following items. First and foremost, I think that the number 11 to 30 or 40 tech stocks will outperform the top 10 tech stocks. Okay, so this year it was about the Magnificent Seven, or let's even make it 10 stocks. But again, I think it'll be 11 through 40 will outperform that top 10. Why? Well, I think that we're getting a little more into the AI game, and so that there's going to be an extension of the benefits into a broader group of companies. So, for example, NVIDIA, which of course is one of the M7 stocks, has a dominant share in what has been the first vertical market for AI. But other companies like AMD and Intel have AI exposure in other verticals, which are, with a bit of a lag, now beginning to be penetrated in the AI space with semiconductors. So that's point number one. Point number two, as a result of my opinion that M7 underperforms other tech stocks, I also believe that M7 may underperform the rest of the market, so that I would expect the equal weighted index to outperform the market weighted index. The market weighted index is made up roughly 30% by those M7 stocks. So I'm saying the other 70 will outperform the 30. I also think the US market will outperform the Canadian market. Why? Well, I've expressed my 2 cents worth on energy. Also, when one looks at bank stocks, we believe that Canadian banks, which will, continue to pay you their dividends, we don't see a heck of a lot of growth, at least at this juncture. Clearly, pricing of a security can change your opinion. Similar to my comment a little while ago about natural gas. I mean, if natural gas goes really quickly to a one handle relative to where it was 2.5 weeks ago, well, maybe gas is not going to underperform for the full front half of next year. Similarly, with Canadian banks, if they reprice even lower sooner, our opinion may change. But at this point in time, we believe that these banks, in addition to having pending credit issues, which they, at this point in time, appear to have comfortably reserved for, we think they have expense issues, and those won't be as easy to overcome. A lot of these banks, you read about how they're cutting bodies, but at the same point in time, they're spending more and more and more on technology. And so they've got expense problems. With respect to net interest margin, we also believe that NIM, or net interest margin, which is the spread between what they lend money out at and what they pay you for your deposit, is inordinate relative to where it should be. So we think that there's probably a little more NIM pressure for the banks. So even though they're cheap right now on a PE basis, price earnings multiple basis relative to history, we still do not believe it's the time to buy banks. And consequently, if the banks, which are, call it a quarter of the TSX, are not going to be good performers, we believe that, excluding currency, we believe the equal weighted S&P will outperform the TSX during 2024. What about bonds? Well, I mean, it depends what you're looking for with respect to your financial assets. I've had the good fortune of working with Dave Townshend and Rahim and Jeffrey for several years, and I know that they look upon each of their clients as having individual needs and different goals. Whether it's growth, whether it's preservation of capital. They have a holistic approach to how they manage your hard-earned dollars. And when I have spoken to them, I've had good fortune of doing business with them with each of my capital preservation focused conservative alternative fund and my growth-oriented long short fund. But they have shown a knack at asking me good questions, which of course I love, because it's fun working with educated advisors like the team is. And when I talk to them about the bond market, I understand how some clients need that cash flow, want that safety of a GIC, but I look ahead into 24 and I see a couple of things happening. Yeah, it's logical to own GICs, but there's going to be reinvestment risk, because once the Bank of Canada starts cutting rates, those GICs are going to start coming down. Obviously, if you're holding GICs out of a taxable account, that may be problematic also. As for bonds, when you got a 10-year, a US 10-year bond down at 420, I don't see a positive risk reward there, because I don't think that 10-year bond yields in the States are going back down to 350. Now, they already have a 3 handle in Canada. Are they going down to 3% here in Canada? I wouldn't count on it. Why? I believe the supply and demand for bonds has changed. Remember, central banks aren't buying bonds anymore. Do you think China? Do you think Japan? Do you think the Middle Eastern countries are going to buy a lot of US or Canadian bonds? I don't think they're going to have the appetite they used to have. Meanwhile, look at debt. We know that in the US, annualized interest expense is about to hit $1 trillion. And we know here in Canada that interest expense on a go-forward basis is going to eat up 15 cents of every dollar of revenue taken in by Ottawa. Bottom line is these sovereigns are just going to issue a lot of paper. So supply is going to stay really high, while demand, I think, is going to be somewhat diminished. And I think that inflation is going to be a little stickier for a little longer. So I don't find bonds particularly attractive. I certainly wouldn't want duration. Private credit, you got to watch what you buy. Bottom line is, I think there is a growing tail risk that's going to be out there the longer that interest rates stay higher. What do I mean? If interest rates come down in a reasonably timely fashion during 2024, such that they're a lot lower as we enter 25, I don't think there needs to be problems. However, if they stay closer than being a lot lower to where they are today, 9 to 12 months from now, I think there is a non-linear increase in tail risk. And consequently, when you get into private credit, you got to be very scrutinous of what you own. Is this okay as opposed to that? And again, I know the team that you have chosen to work in the management of your hard-earned assets with does the homework, knows the differences between what's good and what's not good, because I've had those conversations with them. So to summarize, I think that stocks will outperform bonds and cash next year, and it's going to be the equal-weighted S&P 500 that delivers the performance. I think Canadian banks don't need to be owned until the second half of next year. You'd want to make sure there's clarity that mortgages aren't going to be a problem in 25. And I think energy stocks are going to be okay, but you want your allocation of capital focused on ones that are going to pay out a lot of dividends, because I don't see an expansion in the number of investors that buy energy stocks so as to push the multiples higher that those stocks are accorded. With those comments, I would like to hand the baton or the microphone back to Jeffrey.
Thanks a lot, and basically ticked off a lot of check marks on questions that we had. So I appreciate the in-depthness of it. It's interesting to talk about private credit, because we have, especially in the last 6 months, have been bombarded by a lot of private equity offerings, and that same kind of concern has been there, especially with rates so much higher, and some of the spread between what they're paying out and their outlook versus even just a muted bond outlook, and the additional risk they carry. So I thought that was quite good. We do have one thing here. In terms of, so actually I'll just touch on this. In terms of sectors, you mentioned technology and the 11 to 40 size range.
Yeah.
Any other sectors that you're kind of feeling comfortable with?
I would suggest that industrials should offer some good investment opportunities next year. Companies that will benefit from Biden's industrial policy oriented stimulus programs. I'm not here to push stocks that we own. That's not what I'm here for. But I would say to you that one company that we own shares in that we continue to like the outlook for is a company called Encore Wire. The ticker is WIRE. They're the largest manufacturer of copper wire in the United States. And the stock is lumpy. It's kind of thin, and it's a very it might as well be a private company because they really don't like to interact with the investment community very much. We do interact with them because we've been owning the stock for a good while, but we believe that would be a beneficiary within the industrial space. Ticker is WIRE. So industrials focused on Biden's industrial policy programs. With respect to the financial services space, there are non-bank financial areas that we like. At this point in time, we are involved in subprime credit card companies in the United States, like Discover Financial. We also like payment companies. We believe those companies will continue to do very well. Within the consumer space, there are some resilient segments of the consumer space that offer value. Clearly, consumers have become much more scrutinous at where they allocate their discretionary dollars. And so there's a lot of companies we think are likely underperformers in the discretionary space. And when it comes to the staples space, we believe there's opportunities on the short side because some of these companies have raised their prices so much that their volumes are getting hurt. And there's little room for them to cut costs to make up for the lost revenues from a further decline in volume. So non-bank financials, we think there's stuff to do there. Industrials, we talked about tech, and then I've just mentioned about the consumer space. Gold, I'd probably be more interested in owning bullion than gold, but it's really more for a little safety as opposed to growth. So those would be a couple of comments I'd offer up, Jeffrey.
And then thoughts on copper, just while we're touching on gold?
Well, I mean, if copper can't get a life over the next 2 to 3 months, it'll be pretty stunning, because I gather one of my analysts messaged me telling me that apparently Anglo American has cut its outlook for copper production. I'm just checking copper's price here, $3.78. So between Anglo American cutting its production forecast by 20%, between First Quantum effectively not producing at Cobre Panama for the next 7 months, any recovery at all in Western world demand should cause copper to go through $4. Demand remains very strong in China, with a lot of that demand coming from appliances and electric vehicles. But it's been weak in the Western world. So any recovery at all should push copper to new highs. The problem is finding copper stocks to buy, because there's not a lot of copper stocks. My bias would be to stick with, the larger cap companies like Rio Tinto. But of course, there are many smaller cap companies like a Capstone that an investor can get involved with if you believe that copper is finally going to go up to the degree that we've been told for years it's going to, because of a growing structural mismatch in supply versus demand, Jeffrey.
Perfect. Thanks. Rahim?
Just one quick question, and I do appreciate the comments on wage inflation with the effective unions, because I think it's underestimated at times how the public sector can influence the private sector, even though private sector at times is a little bit more of a self-cleansing sort of industry, whereas a public sector always sets new bars. But, touching on housing, because it's always top of mind for Canadians, there could be some immigration changes on the horizon coming, in terms of where Canada sort of, had an open sort of system. Now they're going to, look to kind of curtail that a bit. And, being from Ontario, like you originally, rezoning potentially is now forefront, changing the green shift or the green belt policies. where do you see a soft landing in housing coming up in Canada, or do you really see, once and for all, the pressure sort of mounting on housing prices? With interest rates sort of elevated for now, but probably downshifting or revising lower to kind of get everybody on the right side of their payment schedules. But where do you see the supply demand and the sort of sticker shock on housing, potentially easing over the next 12 to 18 months?
Well, I think my guess is that it's a function of markets. So it's pretty difficult not to be structurally bullish on real estate in the Calgary area. Whereas in, let's say, the ring around Toronto, like suburbia, I think that's where there'll be a lot of challenges, because there was a lot of speculative activity of people leveraging up to buy real estate that never goes down, type of thing. Versus downtown Toronto, where there is a structural shortage of condos. Or in Halifax, for example, where in concert with my partner, we bought a condo this past year for her daughter, who's going to university in year number 2. And the price to rent a condo in Halifax was ridiculous. And there's not a lot of condos. And so consequently, we thought it made a lot of sense to just buy a condo, even though, get this, we had to pay a 5% foreign buyer, a 5% foreign buyer's tax, whatever they called it. That's what it effectively was. So I think answering your question, broadly, Rahim, is very difficult, because, satellite towns and cities outside of Toronto that have seen a lot of speculative financial driven activity over the last 5 years are probably going to be in rough shape relative to Calgary, where population growth is 4.2%, and the value of real estate here versus Toronto is at a third, for example, of the cost. That's point number 1. Point number 2, with respect to investing, we'd owned Boardwalk for a year and a half, but when it got up to $70, wasn't exactly cheap. So even though the apartment space likely remains pretty good for now, one does have to take into consideration, if they're involved in apartment REITs, as to whether or not rent control is one way for government to be seen as doing something to fix affordability issues. Because obviously that would not be good for an investor in an apartment REIT to see more punitive rent controls come in than an area otherwise has today, or would have if they happen in the future. Point 3, interest rates. Again, I think there's a nonlinear relationship between tail risk and the level of rates 10 months from now. If rates don't go down a heck of a lot in the next 12 months, I think the risk for financial markets in 25 and housing in 25 go up a lot. If the reverse happens, then it's okay. So I would summarize by saying I do believe that cap rates on all assets go higher. In other words, valuations go lower, because I believe growth is going to be lousier and inflation is going to be stickier, and interest rates, generally speaking, stay higher than what we had become accustomed to prior to the central bank starting to hike interest rates in 2022.
Great. Thanks, Jeff.
I think just to be considerate of everyone's time, Andrew, I really appreciate the in-depth knowledge on number of sectors. Clients always love hearing you speak and your thoughts, and there's a reason why you're a core component in our MyWealth strategies. For those who want to sign up for Andrew's monthly commentary, remember to go to www.forgefirst.com, I believe.
Yeah, /commentary.
/commentary
/
and or just shoot me a note and I'm more than happy to add you as well. And with that, stay tuned for the replay in a couple days time once we get the approval, and have a great day. And if for those that we're not speaking to beforehand, have a great holiday season.
A healthy and a happy holiday season to you and yours. And thank you, Dave, Rahim, and Jeffrey, for taking the time today.
Thank you very much, Andrew. All the best to you and your family too.
See you guys.
See you.
Bye-bye.